Hello and welcome to our webinar on how can investors be reassessing their portfolios in light of economic uncertainty. I'm Andrew Thake, Global Head of Content, Production and Strategy for Minds and Money. Before we start, a few housekeeping comments. The webinar is scheduled to run for 45 minutes. All registrants will receive a copy of the recording of this webinar via email, and you can ask questions at any time by using the Q&A tab in the panel at the bottom of your screen. If you experience any trouble with sound, we recommend you exit the webinar and then log back in again. So let's have the first poll of today's webinar up on the screen now, which would encourage you to all go and vote on. So if it's possible to get up that poll now, which is what sort of economic downturn are we entering? Is it a short shock of less than 6 months, a recession of 6 to 18 months, and a depression of 18 months? So if you can go and choose one of those sort of 3 options. And whilst you're doing that, let me introduce and say a little bit more about today's webinar. As you're all aware, COVID-19 has hit the markets hard. Many mining companies are suffering. However, there are also huge opportunities for investors. Which commodities should you be focusing on? How should you be refocusing your mining investments? And where are the wins? To discuss these issues, we bring together 3 leading investors. Adrian Day, CEO of Adrian Day Asset Management, Matt Fifield, Managing Partner of Pacific Road Capital, and Jayant, Bhandari, Senior Analyst at Minerals and Mining and Institutional Investor Consultant for Anarcho Capital. Adrian, Matt, and Jayant, a warm welcome to the 3 of you.
Thanks for having us.
Thank you.
Good. First, we can have the results of the first poll up on the screen. I think that's looking at the polling results, it seems a significant majority think 63% it's going to be a recession of 6 to 18 months, with some of you about 30% are much more pessimistic and think it's going to be a depression of 18 months plus. So perhaps I can ask the first question to yourself, Jan. Is this a recession, a depression, or a short shock?
I think, Andrew, it depends on which area, which country you are talking about. As you can see in East Asia, Taiwan probably did not even suffer much from the virus. China and Korea are back in action. They haven't really had much problem in the last 2 months. Japan is improving very rapidly. So my view is that East Asia will be the first to emerge winner from this whole problem, and their economies will be back on track in a few months. Now, anyone who thinks that the world can do without China has a wrong way of thinking. China is a dominant player in the world's economy. Now, China has many problems, but that's not what the discussion is about today. But China will continue to be a major participant in the world's economy. Now, then comes the Western society. Western society has been stagnant for last many years, and I think that will continue because the West has already chosen the path of socialism and social welfare economies, and there's nothing you can do to undo the harm that socialism does to these economies. But the worst sufferer of the coronavirus issue will be the third world countries. The third world countries will go into a complete chaos because these countries were not only on a downward trend economically, but coronavirus has completely disoriented them, and they are mostly incapable of controlling the virus anyway. So the biggest sufferer from the coronavirus will be the third world countries. The West will continue to be stagnant, and East Asia will emerge winner from the virus situation.
Bringing in Adrian into the conversation, did this downturn happen due to COVID-19, or were we due a downturn anyway?
Yeah, good morning, and I apologize for not having a video. I think to a large extent, it was a bubble in search of a pin. And to paraphrase my friend Peter Schiff, what's important is not the size of the pin, but the size of a bubble. Now, it happens in this particular case, so we had a pretty big pin, both with the virus, but far more importantly, with the restrictions that were imposed in response. They were certainly a big pin. But the bubble was also very large. I don't actually think, and I argued with some of my friends, I don't think the stock market here in the US or around the world was really in a bubble, though some sectors were. And valuations were certainly very, very stretched. But, you know, interest rates were in a bubble, debt was in a bubble, monetary policy, if you like, was in a bubble. So it needn't have been Corona, I don't think. But something would have pricked this bubble in the next several months. And stocks were certainly overdue for a significant correction, if only, frankly, because of declining earnings.
Let me bring in Matt in the conversation. I'm just interested in your perspective as to how a different regions set to fare from the downturn. I mean, Jayant, in his opening comments, pointed out sort of a differentiation between East Asia, developing, and the developed world. Would you sort of like agree with Jayant's observations, or would you have a slightly different perspective on that?
Well, you know, I love Jayant. I loved your comments. From my perspective, I have a much more hawkish outlook, and I'll walk you through how I get there. So, first of all, it feels as though, you know, in some respects, the demise of globalism is upon us. And when I look out and I try to think of what the likely future looks like, it's protection, it's acceleration of where we were at the end of 2019, increased protectionism, increased nationalism, more tariffs, more barriers to trade, not less. And how we get there is interesting. Our thought process is, if you were to take this, the global shutdown in response to the pandemic, it's a little bit like a car wreck. It's very sudden, it's very surprising, and people are hurt. And normally when one person gets into an accident, somebody else can lean over and say, can I help you out? But what has happened here is we've had this has never happened before in the world, where the entire economy of the world essentially ground to a halt for a brief period of time. And so everybody had, everybody's car crashed. Everybody's sort of in that hurt and recovering moment, and in a sort of a non-trusting place around that. And all of the governments and businesses will have spent a lot of money to keep things going. And so the way that we get to a more protectionist world, in my belief, is consumers have gone through a lot of trauma, small businesses, a lot of trauma. They're not going to be taking nearly the amount of risks in terms of staffing, hiring, business travel, on and on. And so more stimulus that will come and be pointed at consumers and small businesses will kind of fail only because of time, not because, it takes time to recover from a shock like this, when you realize that you're mortal, or that there are flaws in your business or weaknesses in your business. So the way that I see the big economies eventually kickstarting is through direct, governments have their hands in the economy. They're buying public debt. They're supporting winners and losers. And I think what you'll see is really intense and directed industrial stimulus. And when I listen to what's going on, there's a lot of talk about, what's the word? Supply chain resilience. Well, supply chain resilience is really just another way to say, I'm going to protect my supply chain from you. The US and Europe and Asia are going to begin to drift apart, and you're going to see duplicated supply chains and barriers to trade that keep me safe. Now, Jayant, one of the things I probably do agree is that for emerging markets and high growth markets that come through coronavirus without big health setbacks, they're actually in a really interesting place, because you'll have a shifting geopolitical alliance looking for markets that can consume, growing markets that ultimately are full of the next generation of consumers. And a lot of those economies actually have natural resources that can be relied upon for these strengthening supply chains too. So I can see an outcome probably 24 months out, 24 months out, where the big winners out of this are a select number of those emerging markets, because they have a lot of people that want to be courting them for those attributes.
Okay. Thank you very much for that. I think with that, let's kind of bring up the second poll for today's webinar. And I want to take a sort of analysis of focus a bit more on the impact of the mining sector. So the second poll that will shortly be coming up on your screen is how optimistic are you for the mining sector over the next 12 months? I've got 5 choices ranging between very optimistic, quite optimistic, neutral, quite pessimistic, and very pessimistic. Whilst you're sort of like voting, I know that I spoke offline with you, Adrian, before this webinar. How would you sort of like vote?
How would I vote?
Yeah, this poll.
Well, I hate to say it, but you know, I'd like to know exactly what the question means. Am I optimistic about mining stocks? Am I optimistic about gold mining? So it's a very mixed bag in my mind. I hate to answer a simple question with a complicated answer. You know, gold mining stocks, I'm extremely optimistic, not very, extremely optimistic. But the whole, you know, base metal mining, fairly neutral or even reasonably pessimistic for the next year, I think.
Mm-hmm. And for yourself, Matt, again, whilst the audience is just finishing off voting, how hard has the mining sector been hit? For a private equity fund like Pacific Road, what are the opportunities and challenges that it brings?
Sure. Thanks, Andrew. Good question. So let's talk about, look, Adrian nailed it. The question requires a little bit more definition. From a valuation perspective, it's the tale of two markets. You saw gold come down about roughly 20%, total market cap of the entire sector in the sell-off, and is now up 17% from the beginning of the year. And you saw everything else that is not gold come down 35 to 40% and stay down, you know, 25 to 30% from the beginning of the year. So you really have a divergence. You have gold and you have everything else. And while 17% from the beginning of the year over 6 months, you know, that's obviously a high annualized rate of growth. You've seen other asset classes that give that kind of performance all the time. It's really the relativism of the up, down, and the spread that makes it feel, it gives it that real wow factor. When you talk about, so that's sort of, that's some of the impact that's merely around market forces, I would say. Step back, going into this, I would argue that the mining sector is probably the healthiest it's been in the last 12, 13 years. Sure, there wasn't a lot of equity capital formation around growth projects, but most of the producers had balance sheets that were in reasonable shape. And from 2013, after the growth cycle, from 2013 to today, what you're really in a place where it's been about sensible cost control, you know, reasonable growth, return money to shareholders. So there's a whole group of corporate managers that have come up through that crash in 2013 and running a progressively tighter ship and maintaining a sense of discipline. And so what that means is when everything is ground to a halt, a couple of people have done some equity raises or termed out their debt, but balance sheets have been relatively healthy. There hasn't really been panic. So it's really only in the medium term, and this is where most of our discussions are. It's in the medium term, specifically around either growth projects or around single asset companies, that they're just not sure what the medium term is going to look like, and so they're looking for, like any sensible person would, you know, deep-pocketed, you know, knowledgeable investors to come along and help them. I think that the other aspect of that is that may not necessarily apply to gold, where gold is just, you know, it's moving as fast as could be, and particularly with drop in oil prices, drop in currency, you're seeing more and more cost deflation arriving and the expectation of expanding margins.
Okay.
Could I share the result from the last poll?
Yeah, that would be great. I mean, if we can have the second poll result up on the screen. Yeah, I think I probably owe an apology to Adrian and the rest of the panelists. I should have probably chosen a slightly better worded question. So be evenly split between quite optimistic, neutral, and quite pessimistic. Just another reminder to everyone who's dialing in, you're welcome to send in your questions at any time, and we'll look to go and take those as soon as you send those questions in. Next question back to yourself, Adrian. How many mining companies can we expect to see go out of business as a result of this downturn? And I guess that the real question behind the question is, how do you, as a seasoned investor, de-risk your portfolio to the dangers of investing in mining companies?
Yeah, well, obviously your question begs the question that some companies will go out of business, and I don't really expect that. Matt mentioned how a lot of the companies are in far better shape now than they have been for a little while. You know, we may see some takeovers, we may see some, you know, base metal exploration companies, you know, go into gold exploration or something different like lithium or something. But, you know, I don't really expect companies to go out of business. And the junior companies, particularly in Canada, where so many are headquartered, have a remarkable ability to continue in existence long after their sell-by date. I'll say something that I often say that's kind of controversial among mining executives. Contrary to the constant moans of junior CEOs, I think it's far too easy to raise money in Canada and keep the living debt going. When I'm looking at companies, particularly now, but all the time, one of my main focuses is the balance sheet. And I always look at the balance sheet, the burn rate, the discipline that the company has shown in the past, both in raising equity and dilution, and on the other side in spending and cutting spending when necessary. So all of those sort of balance sheet issues, that to me is the most important thing that I look at. And frankly, when I'm looking at an exploration company, I look at the balance sheet before I look at the properties. Yeah, so it's money, it's people, it's the history of those people, what they've done in the past that's important to me.
Okay. This has been sent in by one of the audience members, and I'm going to probably ask it to yourself, Jen. First of all, is do you invest in royalty companies? And also, are royalty companies really as good as they seem? And do they have a place in your, or indeed an investor's portfolio currently?
Andrew, that's a question for Adrian, or that's a question for me?
A question for you, Jayant.
Okay. Well, I absolutely love royalty companies, but royalty companies tend to be very expensive for the underlying values of these royalty companies. What happens with royalty companies is that they so often trade for 2, 3, 4%, 5% earnings yield, but life of a mine is usually about 10 or 15 years. So how am I going to get a return of my investment over a life period of the portfolio of mines and a portfolio of royalties that these royalty companies own? So my problem is not with royalty companies. I love royalty companies. I would like to invest in royalty companies, but most of the big royalty companies, particularly the companies that get better known, tend to trade at a multiple of their NPV. And I don't like to buy anything higher than the NPV of that valuation of that company. So that is where my problem with royalty companies become, because they tend to be overpriced usually.
Okay. Question for you, Matt, is do you think as a result of the downturn we'll see more mergers and acquisitions? And if so, in which sort of sectors of mining?
So again, let's go back to that tale of two markets. First of all, in general, I would say X gold. The answer is no. Right now there's a high degree of uncertainty. That's just not a great environment to be making large strategy altering commitments right now. So if you want to go from now, could be even 6 months from now, while most of the industrial facing mining companies are looking around and there'll be one or two, right? There'll be one or two, but it's not going to be pervasive. It's just not a conducive environment for that. As volatility comes down and a clearer medium-term worldview emerges, yeah, I think then you'll start to see more mergers and acquisitions. From an M&A standpoint, I think of this more like 1997 to 2003, in that kind of a time frame, where metals and mining market was beat up, the dot-com bubble burst. Economic growth was kind of slow and stagnant, and there were a series of mergers and acquisitions that were really around synergy, cost saving, survival. That would be kind of the paradigm that at least I'm sitting in right now. When you go in and you shift into gold, I think that that the times are upon us that we're going to start to see cash mergers, and people are looking for growth. Anything with a permit on it and a DFS, everything works at $1,800 gold, and so you're going to be seeing people upgrade reserves and resources to higher gold decks, manufacturing ounces out of cutoff grade. It's just that's what happens right now. So you'll see probably in this kind of a market a loosening of discipline. That's my expectation. In response to a search for growth to continue the party.
We've had a few more questions that have been sent in. An interesting one that's been sent in from Richard Kemp. And I'm going to pose it to Adrian Day. Adrian, do you feel that the broad markets will be propped up until after the US November election? And how do you feel the gold equities will perform before and after the US presidential election?
Oh, that's a big question. Yeah, I mean, I'm not exceptionally pessimistic on particularly U.S. stocks and probably most global stock markets at the moment, just because of the amount of money that's being pumped into the system. I mean, when this money, when money's created, it has to go somewhere, and we certainly saw that in the last several years. So I mean, I think in the near term, we're going to see certainly a test of the lows, if not a takeout of the lows. But I don't think we're necessarily going to see a 1930s style sort of crash and stay down for a long period of time, just because of the amount of money that's floating around. But one thing I will say, and that is that even after the crash that we had in March, and we've had a recovery, of course, stocks are simply not cheap. When you think that we've got this coronavirus, we've got the economies of the world shut down, we had a market crash in March, you would expect stocks to be bargains, right? And the plain fact is that they're not bargains. They're not bargains in terms of price, and they're certainly not bargains in terms of valuation. I'm a contrarian. So, middle of March, I got really excited and started looking at all the companies that have been in my shopping list. And there wasn't anything in the broad market worth buying, frankly. They're still not cheap. But I think, yeah.
A question that's been sent in on uranium, and just to any of the panelists, what are the panelists' outlooks on the uranium market, mid to long term? Does anyone have any uranium exposure in their portfolios? Can I perhaps turn to Jayant first?
Okay. Well, listen, Andrew, uranium price, spot price has gone up quite a bit over the last few weeks, and the market has become very excited about it, as if something fundamentally has changed with uranium, and it hasn't. Most of the uranium is traded in the long-term market, and the long-term price has only moved about 10% or so, I would say, in the last 4 years or so. So uranium price has been fairly stagnant in the long-term market, but the problem is that you cannot really project into the future what the uranium consumption would be in the future. And we have to remember that uranium projects have actually become extremely expensive compared to wind-based electricity generation, sun-based electricity generation, and now oil and gas-based electricity generation. So I have no interest in projecting a higher price of uranium than what it is today. Now, what happens with a lot of uranium investors, particularly the ones I have come across, are that they are very fanatic about uranium. You cannot say a word against the goddess of uranium. If you do, then they all gang together and want to bitch about you. And they are expecting uranium prices which are probably 2 times or 3 times the current uranium price. Now, they are often retail investors who have no direct connection with the uranium market. Now, who should know better about the uranium price? The consumers and the suppliers, or the retail investors who sit in their echo chambers and trade sound bites? My guess is that the suppliers and users actually have a better understanding of the future of uranium market. So no, I have no way to project the future of uranium price. I don't think the price change over the last few weeks signify a fundamental change in the uranium market. And in fact, I think the uranium is a dead end. Uranium electricity generation is a dead industry as it stands today. I don't see much future of it, but I particularly feel sympathetic about those retail investors who have invested in the uranium exploration and development stage companies, expecting uranium prices to go up 100 or 200 times. They won't make 10 times their money. They're more likely to lose everything that they have.
Okay. I'm just curious.
Can I just jump in, Andrew? Sorry.
Yeah, sure. Adrian?
Sorry, just very briefly. The other thing to add to that is what worries me a little bit about uranium, let's say on a medium-term basis, is that the current price jump that we've seen is driven by what I call an artificial shortage. MacArthur Lake shut down, now Cigar Lake has suspended, Kazakhstan has cut back on their production. And so there's plenty of uranium around at a higher price. And so we see sustained prices a little bit higher. And, you know, Kazakhstan will boost their production again, MacArthur Lake will restart, and so on. It's an artificial shortage, not a genuine shortage of real products, say, that I believe we see in the copper market in the years ahead.
Perhaps we can just bring the third poll of today's webinar. If we can just bring that up on the screen, Mina. And the question for the third poll is, which commodities should you be focusing on? And you should have a choice of 5 options: gold, other precious metals, base metals, battery metals, or other. Just while you're voting on that, I just want to ask a specific question to Matt, which is specifically about what will be the impact of COVID-19 on EVA adoption. Will all this clean air that we're breathing now make us ditch our gasoline fuel cars for lithium battery powered EVs? Has the EV investment thesis become stronger? Is this the events of the last few months?
Yeah, it's, you know, look, you have to retreat back probably to my fundamental view. So I believe that EV sales are going to be weaker, and I think that EV infrastructure is going to be stronger than people expect. And where I think that there's a potential surprise for everyone sits around the focus and concentration in utility scale batteries. So, Andrew, when you step back and you think about decarbonization and the push towards metal energy or any of the euphemisms that that people are using there, that's it's an unstoppable force, and you're seeing it continue apace. Right now, in China, they have extended the subsidies and tax breaks for electric vehicles another 2 years, and they've started funding charging stations. And that, again, that sort of syncs with my worldview. Consumers, they don't need to buy cars. Buying an electric vehicle, you know, versus an internal combustion engine when gasoline is free becomes maybe a harder choice. So the self-acknowledged hole in my outlook could be that in order to promote increased adoption of electric vehicles or stimulate economies and start to develop the electrification supply chain into these different protected supply chains, you may see consumer-facing stimulus or subsidies and taxes to continue the encouragement of that. But generally, we think the EV adoption rates for the next 2 years are lower than expected. And then, again, you're going to see these directing programs that are people making that long-term bet, and that will cause infrastructure in other areas to come.
Mhm. Okay. Thank you very much for that. Can we have the results of the third poll up on the screen, Minna? Okay. I think gold was the clear winner there. I want to ask the next question to Jan. Is investing in the mining industry compatible with environmentalist demands?
Oh, absolutely. I have no problems with that. If regulations against the mining industry increase, and if I think it will take another 5 years for a certain project to come into production, all I have to do is to discount valuation of that project by another 5 years. It becomes a fraction of what my valuation would have been had I not discounted it by another 5 years. But that is a loss to the jurisdiction that is imposing the regulations. And maybe some of those regulations are legitimate. Maybe all of those regulations are legitimate. I really have to make sure that my capital gets the respect it deserves. So if regulations are going to delay a project from coming into production, the society has to pay for it, and that cost must get passed on to the ultimate consumers. That is how I look at it. So I don't worry much about increasing regulations. What I want to make sure is that the cost of those regulations get passed on to the consumers. At least from my point of view, that is how I discount valuation of these companies.
Mm-hmm. A question related to that that's been sent in by Andrew Dittman, and I'm going to probably just pose it to Adrian Day first. Post COVID-19, what is your view on both thermal and metallurgical coal? Do you think that we are experiencing a major boom due to the global stimulation?
No, I mean, I suspect that market is on a long-term, downward trend, and there obviously be circumstances that cause the long-term trend to sort of slow, but I don't think coal really has a long-term future. And I'm talking long-term. I mean, there's places in the world that will continue to use coal for a number of years, of course, but it's not anything I'm looking at in particular.
Bringing into that is, what is your outlook on the future of coal, both thermal and met? And I think also linked to that, will ESG become more or less important as a result of the downturn, and how can you factor ESG into your investments?
Sure. First, let's talk about, so I view thermal coal and metallurgical coal as two completely separate end markets. Same geology, different end markets. When you think about thermal coal, a growing emerging market means more thermal coal, and the lack of capital formation over the last long while means that there's a certain amount of supply restriction, and you'll see those trends continue. So I actually think you'll see very few new coal mines being built in the thermal coal sector because of the capital restrictions, but you'll still continue to see that market move and to a certain degree thrive as people are coming online, until you see renewables taking a lot more of the share in emerging markets. That being said, as the total market for thermal coal compresses, people aren't shutting their mines, and so you're finding the same amount of tons to some degree chasing in certain markets, chasing fewer and fewer homes, and that's what those are the two dynamics of the pressure. In terms of metallurgical coal, we're very constructive. We're constructive on infrastructure. We're constructive on stimulus. And the same lack of high quality development projects, lack of investment in metallurgical coal has happened as well. So we see probably a far stronger outlook for that. When you turn to ESG, the question was really, has it become more or less important in sort of the pandemic and the recovery?
Yeah, because I think that sometimes when I speak to people post COVID-19, you get the feeling that despite what they might be saying on their websites and on their corporate slide deck, is that maybe due to COVID-19, ESG has slipped from the top of CEOs of mining's in-tray, maybe down to the middle. And I'm just curious, is like, do you think that post-COVID-19, ESG will reemerge as being the most important issue within the mining industry?
Yeah. Okay. Look, from our standpoint, ESG is another one of those unstoppable trends. So we do it every year. We do a survey of the ASX and TSX listed mining companies. And what you find is that big companies are providing a lot of risk disclosure around their material risks in the form of standalone reports. 68% of companies with over $1 billion in market cap produce a standalone report. And smaller companies don't. It's 16%. So 16% don't, 68% do. And one of the challenges that you have is mining is seen by generalists as mysterious and highly technical and full of headline risk. And some of that reputation is probably deserved over a medium or long stretch. But functionally, this industry is competing for capital with everything else that an investor could look at. And then there's mining. And so some of it's about learning to compete. And the problem is with the pullback, I agree, Adrian, with your overall comment on the market and the cheapness of it, but everything did get cheaper, right? So before, when we're talking to clients about investing in metals and mining, they're saying metals and mining is so cheap and everything else is so expensive. Now there's a lot of bargains all around. There's more bargains in energy. There's more bargains in consumer, cyclical, airlines, whatever. So if you're looking for a beat up sector, there are more beat up sectors that don't have some of the same, some of the same ESG risks that you see in mining. And so I think it's fundamental for people that want to raise and form capital to take it seriously. They have to take it seriously. Because if they don't, they'll find that they're unable to compete. That's sort of probably the central point.
Yeah. Adrian, when you go and invest into mining stocks, how much do you go and factor ESG into your mining investment decisions?
Well, I don't really. I think ESG, and I'm sorry to disagree, I think to a large extent, some of this has just become a fad. Obviously, taking care of the environment is important. If there were a mining company dumping mercury into the river, I'm not going to be investing in that. But do I really care if they have 2 women on their board, or no women, or 6 women? I just don't care. I think a lot of this has become very bureaucratic. It's become checking boxes. There are obviously people in the mining business who believe fervently in the environment and doing the right thing by companies, doing the right thing by the community, by governments, doing the right thing, more importantly, by the communities in which they operate. All of that is very important. I'm not discounting that at all. And there are companies, you could name, lots of them, who are very genuine, very fervent, and have been for 20 or 30 years before it was a fad. But when you say that ESG is the most important thing on a CEO's mind, I think that's what you said. I mean, the world is upside down. That shouldn't be the most important thing on a mining CEO's mind. The most important thing should be finding ounces, producing ounces profitably. That's what he's in business for. And putting ESG first is like putting the cart before the horse. That's my 2 cents.
Yeah, I think just to clarify, I think that ESG is certainly much more important. I think that ESG is much more important when one talks to the majors, the mid-tiers, and the producers, than maybe to the junior producers and the exploration companies. And again, I think the top of the in-trade comment was probably broadly true around about January of this year. I guess the question I originally asked to Matt was how true has it come sort of like May 2020. I'm just interested just to kind of come back to Matt, is to what extent is kind of, I think as Adrian alluded to what extent sometimes ESG for some mining companies a tick box exercise, or is it sort of changing and it's becoming much more than that?
Well, look, Adrian, I'll just talk to Adrian. I understand where you're coming from and sort of the point of view. When you're talking about May, April, March, right? When you're in the middle of a crisis, you start with what's the health and safety of your workforce, how secure your infrastructure. I mean, you go through a crisis management protocol where you start inwards and then you build outwards. And I guess I would equally agree with you that in general, mining companies, because they operate in a regulated environment, operators have a good handle on their E. Maybe they don't pitch it well enough or tell people about their material risks in a way that they can understand, but they operate in a regulated environment. And so generally they're taking care of E. Most of the companies are public, so there's some form of governance. They're not ungoverned, and there's a range of things there. And it's really on some of the points in the middle around S that you find that I think that's where the dialogue has shifted over the last 5 years, where you find people that are much more proactive around their stakeholders and their communities. So if you step back to where we are in May, in my mind, it's actually it's just good business. So particularly in some of these remote communities and third world countries, you find that mining companies have a supply chain, well-organized, safety-trained people. They have hard and soft infrastructure that, and they have a huge economic multiplier that around which an entire ecosystem of people live. And so to only focus on what's in your mind gate and ignore the fact that you have an entire ecosystem of people around you, that doesn't really fit with my value set. So, look, you can debate all the different aspects of ESG. When you come at it in times of crisis, when you have strength, like these companies do, what we're seeing both in our portfolio and as an owner of these companies, I'm happy to report that they're using that hard and soft infrastructure to help their communities, which are the families of people that work in their companies, to get through these moments of crisis. So, is that the same of some of the things that you pointed out as good and bad ESG? I'm not sure, but I know that strengthening those social bonds in a time of crisis, people remember. They remember how you acted when there was trouble around, and I think that ultimately helps when you're acting the right way, helps de-risk a company. Strengthens the social license. Those are the type of behaviors that we're proud of in our portfolio companies and other people when we see them.
Yeah, Matt, sorry, and let me just jump in quickly. I don't mean to leave a wrong impression. Certainly,
Sure.
Certainly companies that operate particularly in foreign countries, go to far out of the way communities. They have to take account of that local community sensitivities, and of course, that's something that we look at very, very carefully when we're looking at companies. And I can't tell you how many mining trips I've been on over the years where there is just night and day between the team that goes down and, all the people in the community come out and welcome them, and there's hugs and kisses from the cooks. And that to me is an indication that they're doing something right. And then you see the guy with the slick Brioni suit. Nobody wants to even shake his hand. There's something wrong. And all of that stuff is incredibly important. Don't misunderstand me. I just don't like the sort of compliance and the bureaucracy and the box checking that seems to accompany this whole issue.
Yeah, like it's.
But I just want to. Yeah.
Yeah, I'm with you. I understand. The box checking, it really comes down to company culture, doesn't it? It's not so much the box check. Box checking can be a tool to help guide a conversation, but checking a box just to check it, I don't know that really adds value to the world.
I think with that, we've got about 5 minutes left of the webinar, so I'm just going to take a couple more questions from the audience. One question that was sent in that I'm going to ask Jayant. Jayant talked about China at the very start of the webinar. It's a question from Dowjit Singh about should the UK government have a similar strategy to China and take control of key mining and mining-related assets. I'd also like to probably maybe ask if you can also expand on that and also talk about what extent you think we'll see more renationalization and resource nationalism as a result of this economic downturn.
So, Andrew, I see no reason, absolutely no reason why any government should nationalize their mines. There is no reason for, let's say, the United Kingdom to nationalize. They don't really have many mines anyway, but there is no reason ever for the government to get involved in business. They can't really do governance properly anyway. They don't really have the accountability. They don't really have the meritocracy in the government to run companies. So nationalization is completely out of the way. Certainly for commodities, you can always buy commodities. You can, if one country stops supplying you commodities, there are so many other countries that can supply you commodities, or they become a bridge for you to get those commodities. So again, I have no reason why government should nationalize mines. When they nationalize mines, they destroy those projects, they destroy those companies. You can recall what happened with Resoro and Crystalex in Venezuela. Those projects are not even producing today. And were they producing, they would have been paying hundreds, literally hundreds of millions of dollars in taxes every year, apart from giving employment to a lot of people and apart from generating a huge amount of value. And you can see the same thing repeated again and again in a lot of jurisdictions where countries that try to overtax these companies or nationalize these companies end up losing out mostly completely. Was there another question, Andrew, there?
I think it was just the case of where you thought that resource nationalism would also become stronger as a result of the economic downturn.
I don't see this happening.
Yeah. Okay.
Yeah, I certainly don't see that happening. You know, in my view, Africa is going to face a huge amount of problems going forward. A lot of third world countries are going to face a huge amount of problems, but they are going to have to open up to allow foreign investment to come in. So I don't see any reason right now for them to nationalize anything.
Okay. And thank you very much for that, Jayant. And then I think I'm just going to ask one question to all three of you. And I'll ask Jayant to answer it first, followed by Adrian, followed by Matt. And the question is, just to bear in mind, the title of this webinar was about how should investors go about rebalancing their portfolio. What's the one piece of investment takeaway advice you would give to the audience today with regards to rebalancing their portfolios, regards to mining and mining stocks? Perhaps I can ask you to answer that first, Jan.
Well, I mean, bear market is really the best time to make money, Andrew. When things get sold off, people sell whatever they have in their portfolios because they are very fearful. People who sell things off in a moment of fear are people who haven't really done any valuation. They have no numbers on these companies, so they just operate through emotions. And if they were, if instead of operating through emotions, if they had actually objectively done some numbers on these companies, they would have actually prepared themselves to buy those good companies that fell off the cliff in the last month or so. And those companies would have already made them a lot of money. Bear market is really the best time to make the most money in the least risky form. When the market is bullish, that's exactly when I want to turn my shares into cash. And maybe I want to move into other sectors that are in a bear market at that point of time. But for me as an investor, the best time to invest is when the market is in a bearish mode.
Adrian?
Yeah, I don't disagree with what Jayant has said, of course. And typically, I tend to be a contrarian. I tend to be a value type investor. And there's no question that gold stocks have had a remarkable run in the last month, to the point where I think the market is really overdue for a bit of a pullback. But having said all that, I think the one piece of advice I would say is that those of us who've been around the gold stock market, you know, for the last 5 or 6 years, seen a lot of false starts, you know, maybe lost a little bit of money along the way. I think we have to have a shift, let's say. We have to have a shift in our approach to the gold market, because if what I see happening in the gold market over the next, let's say, 2, 3, 4 years, mostly because of the extreme amount of debt and the extreme monetary policy that's being followed around the world, if what I see happening to gold, and we see gold over 3 to 5 years, you know, at 2,000, 2,200, whatever, the gold stocks will go up meaningfully from here. And looking back in 3 years' time, it won't really make any difference, let's say Barrick, whether you bought Barrick at 28.20 or 27.80, it just won't matter. So I think we just need a little bit. It's difficult sometimes, you know. I'm still waiting to excuse me. I'm still waiting to invest for some new clients because of my nature. I'm looking for best prices all the time. But I think we have to have a little bit of a shift, be a little less picky in terms of price, and certainly less quick to take short-term profits, because there's a fundamental long-term bull market, in my view, in gold.
And the last word to Matt.
You know, I just want to hang out with Adrian for a little bit. I couldn't agree more. You don't need to bottom tick gold right now. The forces are too big, too strong, you know, 30, 40% of GDP, more stimulus to come. It's just the fiscal stimulus and central bank-led stimulus has enormous knock-on effect. And so what we're looking at and what we're recommending to clients is really a barbell strategy. If it's deflationary or if it's very inflationary, you'll be happy to have gold. And then in the middle of that barbell, we're really looking at things that we think will outperform because of highly directed stimulus, which we think is sort of the second or third tool that's coming. You don't need to rush into those right now. There's still, there's a lot of value on display. There are good companies, well-run companies that are going to benefit from big trends, whether it's stimulus or electrification. And so that's how we think about it. Gold is protecting you if the world is not going the way you want it to. And then if the world is going the way that you think it will, a recovering economy is going to benefit the middle of that slice.
Thank you very much for that, Matt. And I think we're out of time. So apologies to some of the questions that we weren't able to get around that were sent in by the audience during the webinar. But as I said, we are out of time. Thank you once again to Adrian, to Matt, and to Jayant, and thank you to all of our listeners for dialing in. As I mentioned at the start, all residents will be sent a recording of this webinar. Also, don't forget we have lots of upcoming online events. We have our 5 at 5 show tomorrow at 5 p.m. British Summer Time. We have our online Connect shows on the 23rd and 25th of June in the APAC time zone, and our EMA Online Connect on the 30th of June to the 2nd of July. And of course, Minds and Money London will be running on the 1st and 3rd of December, and IMARC on the 26th to 29th of October in Melbourne. For more great news and content, please check out our Mining Beacon website at miningbeacon.com. Many thanks, and see you again soon. Thank you very much.
Thank you very much.
Thank you, Andrew.
Thank you. Thank you.